A very good afternoon to our webinar today. On behalf of Brenthurst Wealth, I'd like to welcome everybody to our jam-packed webinar on things related to investments. I'd like to say hi to our guest, Mike Schussler, the economist, who's also now the consulting economist to Brenthurst Wealth. And I'd like to say hi to Tony Bell. He's from Bonani Capital. And Tony's been running the IP Opportunity Fund for clients of Brenthurst Wealth for more than 5 years, and in the process also winning 5 Raging Bull Awards for his consistency on the offshore markets. And then to all our clients countrywide and all the newer members joining us, I'd like to welcome you very much, and I hope you find the webinar of interest and importance. And then finally, a warm welcome to the residents of the Evergreen Retirement Home or village down in Valdevie, where Brenthurst has just opened a new office, and we have invited them to attend our webinar today. The background to our seminar today is investing in a post-COVID-19 world. But before we do that, we need to step back in time, especially for those investors who have not been with us for a long time, as 10 years and more. And the context is the debate raging in investment circles today is offshore versus local investments, and how much should you be having in your local investments and how much should you be having in your offshore investments. And the context is that around about 2010, 2011, we started noticing that markets are diverging. South Africa, which up to 2010 has been a very good place to invest your money, started underperforming the rest of the world. And we started recommending offshore investing, firstly as a diversification, and that people should consider some of the fast-growing economies of the world, especially what was happening on the Nasdaq, the US market, but also countries in the East like Japan, and to a later stage, Asia, Korea, and those places. So gradually we started increasing our exposure to these parts of the world. We started putting clients into things like technology, biotechnology, healthcare funds. And here is a 10-year return number that is very of importance today. And it shows very clearly that investors who had taken their money offshore 10 years ago, and not everybody did, but a lot of people did take their money offshore, slowly at first, but when they saw the results, they increased their exposure to offshore markets. So over a 10-year period, you'll see that if you compare the JSE all-share total return, that is capital growth plus dividends, on a 10-year basis, the growth was 292, and that is the green line at the bottom of the chart, which shows that relative to the rest of the world, we were not keeping up as far as the performance was concerned. The place to be over that 10-year period was, of course, the Nasdaq, but it comes with higher volatility. But there you made 1,428% over a 10-year period. The S&P 500, 800%. And if you compare us with a total world return, which is perhaps a better measurement, they grew at about 600%, which was more than double the returns on the local market. So over a 10-year period, ladies and gentlemen, no question, the call to take some of your money offshore, in some cases all of it, was a very good call to make. So let's see what happened over a 5-year period, and we'll see that the same performance, the JSE right at the bottom, with a return over 5 years. Again, it's a total return 148%, compared to Nasdaq, which was 327, 220 for the S&P 500. And these markets were driven by the very big internet companies, Amazon, Google, Facebook, Netflix, you name it, it was happening in that market. And even a company which has a South African link, in other words, Tesla, doing great things for their investors. And again, when you compare us using the same measurement, we were stone last over a 5-year period. So over a 10-year period of time, no questions, offshore was the place to be. Over 5 years, over 7 years, In over 3 years, we had exactly the same experience, that the local markets, in fact, had a dreadful 3-year period. And only when you come to the 1-year number did the JSE, particularly from November last year, due to the rally in the commodity stocks, platinum shares, outperformed on a 1-year basis the other indices that we are talking about. However, if you analyze the performance more in greater depth, you'll see that it's primarily driven by commodity stocks, platinum stocks, and of course the performance of Sasol. Only 2 of the 10 top shares in 2020 had anything to do with the local economy, and that was Woolworths, coming from a very low base after the sale of the Australian assets. And the bottom line is that the South African economy, or the SA-related companies, were not doing very well. And at the same time, you had the strengthening of the rand from 1935 a year ago to current levels at 14.30. So there was a very nice base effect. Our market did recover, but we're a little bit concerned if this is sustainable. And there are other advisors and fund managers warning that the platinum sector very, very volatile and difficult to predict. I have a slide that I can only read you the headline. This is from Coronation. It says that South African equities have dropped off foreign investors' radar screens. And we also have a second graph where the outflow of capital from the South African market over the last 5 years is in excess of 500 billion rand. And this is not reported as much as we should. And then I end up by quoting a couple of fund managers and the New World Wealth report, which came out this morning, which talks about exactly what we have been telling our clients of Brenthurst and the general public at large, that the average South African has impoverished greatly over the last decade, anything between 25 and 30% in dollar terms, by virtue of the fact that the JSE has been a very bad place to be. The currency has dropped from 6 Rand 80 10 years ago to 14.50. And combined with that, the general residential property market in South Africa has gone sideways and gone down in real terms and also in dollar terms. So to summarize, and before I hand you over to Mike Schussler to give us an indication of his views on the South African economy, it's been a very successful strategy for our investors to have taken money offshore in order to protect against what's been happening. Our view at Brenthurst, and my personal view, is that unless there is a dramatic change in the economic policies of the governing party, the ANC, this trend will in fact continue and might even escalate. And we see it in things that are now affecting your investment returns in the form of collapsing infrastructure, roads, sewage, waterworks. We, for instance, have Neil Fruneman from Sibanye-Stillwater saying foreign investors are taking their money and investing somewhere else because the infrastructure in many parts of the country now starting to become a problem. Peter Bruce, former editor of the Financial Mail and the Business Day, now very openly saying that everything is falling apart in South Africa. So it's very, very difficult as an investment advisor to ignore these issues. We sometimes clash with the local fund managers who are trying to spin a story that everything is well and alles sal regkom. We don't believe in that. We believe that you need to take a much more global approach to your investments, but we will come back to that at the end of the presentation. So I hand you over to Mike Schussler, a very well-known economist and also now the consulting economist to Brenthurst Wealth. With that, Mike, thank you very much for your time.
Thank you very much, Magnus. I hope everyone can see my charts, and if you can't, please let me know. We're at this moment in time going to do a very quick overview of the real economy, if you wish, in the world and in South Africa, but with a financial taste. if I could call it that. And after COVID, I think we're still not so sure that this is all hunky-dory and happy. I agree with Magnus that South Africa is not a very good place to be with many of your investments. You need to look broader than that. And anyway, we're only about 0.5% of the world economy. We're probably the same with the world's equity, a bit more, maybe 0.6, 0.7% of the world's equity, and even less in that in bond markets. But I'm just going to do a quick thing about the world economy and growth and forecast. I'm going to have a quick look at the world's debt profile, because that's really ratcheting up, and what that's doing to markets as well, because we have to take that into consideration. I'm going to compare South Africa to emerging markets. My thinking these days is South Africa is really breaking away from emerging markets in many ways. And I will try and answer a question about the Rand. I was sent a question a day or two ago, and people asked me what I think of the Rand and where it will be. So I'm going to do a bit of a longer answer there, then about the South African economy, and a thought or two on commodity prices, which will impact South Africa. If you have a look right now, all the forecasts around the world are much more optimistic than they were just 3-4 months ago. And you can see that the average forecast for this year has gone up from 4.7 in the beginning of the year to 5.3%. We think also, if we look a little bit further back, we were looking only at about 4.4%. So literally the world is going to grow 1% quicker than before. Next year it's going to grow a little bit quicker. All round, that is very, very good news, one would think. But not always for everyone. If we take a look at the different forecasts from the Economist magazine, from the Economist group, and from the general forecasts here, you can see South Africa is not doing so well. And although India had a big fall, they will bounce back quite massively at 13% growth expected this year. China at above 8%, and Peru in that sort of territory as well. What is very interesting here is the shift east and the bounce back of parts of Latin America after this pandemic. Right now, this data is the fastest data on world trade you'll get. It's the container traffic reports, and it's up 9% on a year ago. One must just take it a bit with a pinch of salt, because that 9% is on a January where Hong Kong and China specifically was locking down. And it's also before the Suez Canal mess. But nonetheless, we can already see by the end of last year, world trade volumes were really going through the roof. And that was quite surprising. I think one of the things I thought to myself, probably also the reason why many forecasts are going up, is that people saved so much money they didn't want to spend last year. Now they want to spend this year. I think that's one of the reasons. The other thing that we've seen, and it's something I'm hammering on about, is the shift to the east. Last year already, China overtook the EU. Any way you look at it, whether the EU has Britain in it or not, the EU dropped a tremendous amount, and about 7% or so. China grew with 1.5%, and therefore, in all likelihood, overtook the European Union. And then you know that Britain broke away with Brexit. So today, the second largest economic bloc in the world is China. There's no doubt about it. And they are growing rapidly still, and they're likely to overtake the USA in the coming 5-6 years from now. If you look at manufacturing, by next year, I honestly believe that most of manufacturing around the world will be in the East Asia and the Pacific, more than half. China alone already overtook the EU and the USA by 2010. It is really a phenomenal shift. And I don't think we understand the implications of that yet. We're seeing China stand up a lot taller than they did before pushing their agendas a lot harder, becoming a partner of many developing countries, playing a bigger role in the sea and air around China and the Sea of China. And I think the politics of the day will be very different. Then that's the real economy. That's just very much a quick background. What we're going to have a quick look at is the amount of money that the world printed. Now, this is just the USA. I haven't got new figures from Mr. Biden yet. They're not available, but you can see that Mr. Trump really ratcheted up towards the end here, the amount of money that the USA government spent. And that really helped. It was over $3 trillion deficit in the year 2000. And we're now on to 2021. And if we take the whole world's debt, you can see in the last while that the reason that there's dotted lines is that it's still a bit of a forecast for the GDP numbers, but debt to GDP has gone from about 220% worldwide to 247% in a matter of a year. This actually only goes to the third quarter. By the third quarter of last year, world debt had increased to $211 trillion. In the first quarter of the year, it was $190 trillion. So 21 trillion up in 6 months. It will still continue for a while, albeit at a bit slower pace, but we're likely to reach about 240 trillion US dollars in debt. That's a large overhang. Our grandchildren are still going to pay some of this. If you look at that money creation machine, this is a large part of the world. It excludes Canada and Turkey. It's the only two big countries that are excluded because their data is a bit late. But you can see the growth of money supply and how that feeds into the world stock markets. This is the Morgan Stanley Composite Index, just price alone, not total net returns. And you can see it's a 55% increase by the beginning of this year. And that's on the back of a 20% increase in the world's money supply on a year-ago basis. This is the quickest increase in money supply that we've ever seen in our lifetimes. I don't have the data for World War II or just after, but I'm willing to bet that this will be the best or the highest growth, not the best, from then. So it is really a massive amount of money and a massive amount that we'll have to pay back. The other thing is that the markets under those circumstances have become unusually optimistic. And the green line here is the put-call ratio. And it says to me that at this moment in time, for the first time in about 20 years, it's really, really optimistic. And that's a danger sign. But with this amount of money behind it, who knows what will happen? It seems as if, and we're just using the NASDAQ here, but it does seem that there's an inverse relationship between the put-call relation, or not an inverse, a relationship. And I think that optimism can really be too much sometimes, and that in itself starts making one question about where the world equity markets are going to. I'm going to slow down a bit here with emerging markets because I think otherwise I overload you with too much stuff. The point on this graph is just that the average emerging market has been growing at about a bit more than 3 times the speed of us over the last decade. And it's forecast to continue. So the average emerging market is going to grow at about 4.6%, according to the IMF. And South Africa is going to grow only about 1.3%, according to the IMF. It's really not a great thing for us. And it shows that our peers are starting to move away from us. We can also see that in terms of government debt. We're really started piling that on. In the rest of the emerging markets, debt is more private sector orientated, more household orientated, in a sense that governments have very little compared to the private sector. Here in South Africa, it's the other way around. The private sector debt to GDP is about 40%, government is nearer 80%, whereas it's about 70% versus 60% in emerging markets. If you include China, it's 90% private sector debt to 60. So that is the thing. Our debt is not very well, is not earning us much in a government setting. You can also see that the South Africa is paying a premium on its interest rates. Each president here is in a different color, and you can see in the last premium, the last term of the Mbeki term, when everything was still improving to a large extent, our premium was 153 basis points. We're now at 409 basis points, nearly 3 times as much during the Ramaphosa presidency, and it's heading up because the actual basis point differential is now about 506 basis points on 23 emerging markets and us. So that is a huge thing because we have to pay extra for our debt, and that is a painful thing. The other thing is that our exchange rate started decoupling from the emerging markets. Now, for a while in 2001, we also decoupled, but we came back with a bit of an vengeance. But then from about 2008, as we know, the win of Mr. Zuma for the ANC, that made investors a lot more nervous, and we saw that break away. We had a bit of a better feeling when the commodity price index rose to an all-time high close to 2012. But then we broke away again, and today the level of our currency on average is about half the level of the emerging markets. If we look over an 11-year period against individual markets, yes, Argentina has lost virtually everything of its currency. If you have a debt default, this is what happens. Turkey has got the president's brother runs the central bank, and the president's brother-in-law runs finance, and his classmate runs the stats part of it, and so on. So they're also being hammered. Brazil's got problems, Egypt's got problems, but we're also there. We maybe not have a debt default, but very much us and Brazil have, and Egypt have seen downgrades into default territory over the period, and you can see what that does to one's currency. But having said that, only 2 emerging markets have a positive outlook here, and that's China and Thailand. Small for fall that we've had in the last, say, 15 months or so. Yes, we did much, much better. And you can see that Brazil and Argentina and Turkey had a very tough time of it. So yes, we have improved, but that's probably on the back of the metal commodity complex, which I don't understand why Brazil didn't do that, but they were really ransacked, if you wish, by COVID, whereas Argentina and Turkey are not coming right at this moment in time. Russia might be a bit of a letdown with a handover to Biden, but I'm not quite sure there. But the point is, we had a very small fall in the last 15 months, yes, in between. But that makes one wonder, how does one look at the Rand? And I'll get there in a minute. You can see the equity markets in South Africa also differentiated themselves. In the last while, you can see it's a very nice move up. But still, the emerging markets have beaten South Africa. And again, the same theme starts applying. If you go back to 2012, it's very similar. Then we start getting our first downgrades, and we start seeing the problems. And we don't fare as well as the rest of the emerging markets. And that difference is just growing and growing. There might be a narrowing for a while, but I don't think in the long run we are going to keep up with the emerging markets purely through our growth rate on the one side. The other side is that many of our companies are investing outside of South Africa because they don't see the growth here, and very often they don't make great investment calls. Something on the Rand I've been looking at for a while. I've revisited it recently with that question that was sent to me. And I looked at the purchase power parity rand, which comes out every year. And I looked at the consumption, the private consumption part of that. And I then looked at how the rand in market terms fares against that. Now, all emerging market currencies are under their purchase power parity value. If you go and look at the Big Mac index, that will tell you that 45% is the average in January this year, difference between a purchase power parity of the burger prices and currencies. If you go back a few years, you're looking at 35%. So in most emerging markets, that's always the case. So I'm looking at how much of that value comes through. And this is, first of all, the first chart is a very long-term chart, and it doesn't show that much, I feel. It shows that there's two boundaries, a 10 and a 90 percentile thing, but I think one also must be realistic and say things change over time. So I did a second one, and this is where I want to stick for a little while. If I look at the rand here, when we started not the negative outlooks, but the actual downgrades started in September, October of 2012 for the South African rand from the credit rating agencies. And you can see that we had a very flatter trajectory here in the rand as to the previous one. You can see I'm just showing this, and the shaded areas are our recessions as recorded by the OECD. So when I look at this here, and I can see that there is a decline virtually all the time during a recession. And then afterwards, there's sometimes a recovery like we're seeing now. But at the moment, the boundaries of, let's call it the fundamental boundaries of the rand, I say that there's a 10% chance of the rand getting to 12 rand 70. But there's also a 10% chance of the rand going a lot weaker and to 17 rand at the moment. And every year that purchase power parity shifts by a few percent, so does that boundary. So this gives me a way to look at the rand. And right now I could say on an 8-year average, the rand has now strengthened to past where it would normally be on its typical, because it's a median. It's where the rand spends 50% of the time below and 50% of the time above. So we are, for all intents and purposes now, in my book, in a strong rand situation. And we realize that it's not just the rand, there's also a dollar, and we need to make clear this is not only a rand story, because we're like a little bath standing at the side of the ocean. And if the ocean doesn't do much, we just move a little bit with the tides and the flows and the ebbs and all that type of stuff. And we've got a bit of control. We can pull the bath plug if we do the wrong things, or we can fill the bath hole if we do the right things. But every now and then there will be an event, a tsunami or an extreme high tide, and it'll push the bath open. And if all our water falls out, it makes no difference to the ocean. And that ocean is the US dollar or the euro and so on, because the rand does not make up more than 0.5% out of, or 0.5 out of 200, because there's always two currencies. So the dollar is 95 out of 200. So it's virtually 50% of all currency trade is in the dollar or against the dollar. And that tells you how big the dollar is. The South African rand or any other emerging market is not going to have a major role to play. And if you just look at the top 4 currencies in the world who are all advanced economies, or 5 or whatever it is, you're literally looking at 90-something% of all trades. So all the others are what traders would call exotic, or where they don't always want to be. But that's just the background. So I then looked at where I think the rand is likely to be able to strengthen to under reasonable circumstances. And I think if it tests 13 rand 47, that is not unreasonable. But at the other end, if we get another ratings downgrade, all that type of stuff changes again, and the inflation differential between us and the USA here will make a difference. So this is for this year only. But I think overall we're probably going to be go below 16 to the rand, maybe not 17 quite yet, but that will take a few months, 9 months, 10 months from now, as we empty out the current account, positive current account becomes deficit again, all those sort of things. Because when the rand strengthens, we happen to have a very high importation sense. We buy cell phones. It's our biggest import item these days is cell phones, and oil is always there, motor cars. Once the economy picks up and there's anything like household consumption expenditure, it is going to play out in the rand as well. So I think it's a bit above its long run typical. It can go a bit stronger still, but I suspect we're now in a few months or 6 months from now, we'll see a turnaround again. And I think even 9 months. But I think the long run is, and this is what I want to get to, the long run is going to be a decline of between 2 and 4% a year minimum from now on, minimum on average. And I think that is the inflation differential. You add to that the credit downgrade threat, and you quickly see that if you compare us to other currencies, that credit downgrades adds a 5 or a 10% weakening in the process. So you go from 17 Rand 70 without any inflation rate differentials and so on, and you can go to 19 Rand 50 because of a downgrade. And that's what I'm trying to point out here. You have a slight differential in inflation rate increase. You have a bit of a downgrade from one or two of the rating agencies, and away the rand goes. So it is prudent to have quite a lot of your assets outside of South Africa. You don't want to sit like somebody in Turkey or Argentina or Brazil or indeed South Africa over a 10-year basis, a period where you've seen a 50% decline in the currency. Yes, your stock market can make it up for you, but why would you want to be in such a small place with all the risks associated with that currency that is seen as exotic? So I think you have to have a broader outlook. You don't have to put everything overseas or anything like that, but I really think fundamentally the rand is going to go weaker. And we see that with most emerging markets. There's one or two exceptions. We've seen China, we've seen Thailand as exceptions, but it's also not that different to, they don't grow 10% in 10 years even against the dollar very easily. Maybe China from time to time, but generally that does not happen. Okay. What happened during South Africa last year is we had a 7% fall. This year, our Reserve Bank and the private sector economists think we're going to go and grow with the best rate in 10 years. But we're still playing catch up. We're still going to be not growing too quickly. Next year, just around 2.5%, the year after with 2.5%. Then after that, we fall back. The World Bank is talking about 1.3% in 2 years' time for us. Because this, and this is the point I want to get to. If you look at the non-financial private sector, in other words, I exclude insurers, I exclude banks, I exclude stockbrokers, I exclude the government, and then you get to what I would call the real economy. Here you can see the pain that the real economy has felt has been with us for 9 quarters. It's been on a year-on-year basis negative out of the last 10. The real economy now in the 4th quarter of last year was only where it was in 2012. Now, if I tell you in the 2nd quarter of 2012, that's, literally nearly 9 years ago, that's the size of the South African real economy now. Yes, there's going to be a bounce, but it is really already under tremendous pressure. The real economy cannot handle all the troubles that are being thrown at it. It's expected to do better. You expect somebody to grow, but you have private firms having to provide their own water. They have to make do with electricity. They have to pay more for transport costs because the truck tires are going on bad roads. All those sort of things. Plus then you have labor unrest, other unrest the whole time. You have xenophobic attacks, all those sort of things. That's starting to impact the real economy, plus the electricity outages, plus water outages. You name it, it's there. And this real economy is really struggling. There's no two ways about what's happening in South Africa, where the average firm out there is not making much inroads into the growth situation. Yes, their cash flow is positive. That's great. Yes, they don't have as much debt as most in the emerging markets. But why would they want that much risk? They want to minimize their risk at the moment. And that, as Magnus said, can only be addressed by political factors. You have to start talking to the private sector, the real private sector, and you have to not talk just on behalf of the BEE people. You cannot just talk on behalf of the government. You have to sort of say, what can we do for you? And if that doesn't happen very quickly, it's going to be a long downhill struggle here. I'm got a bit of good news as well, in the sense that our commodity prices are going up, and I'll show just now again why I think it's going to stay high for a long time. Part of the answer you've already seen. But the one thing is, if I look at the whole commodity price index, and I've smoothed it here in South African rand terms, the other one is in dollar terms, I'm finding that there's no reaction from the mining sector at the moment. Yes, it was COVID, so there is an excuse. But quite frankly, in February, and a 3-month moving average to February was the lowest since roughly 2015, and before that, 2012. They are not reacting by expanding their production to the higher commodity prices, which have been going up for well on 18 months now. So we're looking and we're expecting this to happen, but it's not happening. And if it's not going to happen, then the employment doesn't happen either. And you can see that in the other line. And that is a concern. I really think we need to wake up very quickly on this. So my last part is, how long will commodity prices stay relatively high? Well, I think I'm going to play into others, I hope. But if you look at the metals index from the Economist magazine, and you can see the inverse relationship with real Fed fund rates. As those real Fed fund rates are low, or when they're lower, it lifts the commodity prices generally. And that's been an ongoing thing for a while. On top of that, you've seen the money market, or the money supply increase, which has gone into equities, but it's also starting to go into commodities and also obviously bonds. That's had a large role. But this time round, it's not just the Fed funds that are low. It's all these other economies. UK at 300-year lows. I'm sure Tony knows even more countries than me on this. But Germany, Sweden, Switzerland, South Africa, we're all at lows. So under these circumstances, the holding costs of commodities is not that bad. And people pile up their stocks a bit. And especially when they see commodity prices increase. So it becomes like a double boom effect. And it's unlikely that interest rates are going to shoot up rapidly right now, or at least the short-term ones. The long-term ones I'm not that sure of all the time, but the short-term ones which central banks have control over, and that will hopefully keep and should keep commodity prices high. So we should have seen a reaction from the South African mining sector. We made it. That's the bright side. South Africa Inc. made it. Smaller businesses struggled in many sectors, but they're like a canary in the coal mine, and they're starting to come out of this very rapidly and quickly. Just yesterday, or the day before yesterday, the food and beverages sector was still negative year on year for restaurants and so on, but the takeaways increased to 25% on a month ago, 0.1% on a year ago, and this is for February. So it shows you that people are still out there spending. They're still able to do. They've maybe shifted a bit because of Uber Eats and Mr. Delivery and all those, and the COVID fears, I guess. So they've shifted to the fast food sector, but we're starting to see it in a lot of stuff. The smaller mining sector is starting to grow very rapidly, but these are small queries and that type of stuff. But there is reaction, which is positive. The US and the rest of the world will keep rates for lower, for longer. Inflation should be low for South Africa, at least, for a while. We need to get our fundamental reforms done now. This is the last chance saloon. If we don't do it in the next year or 2 or 3, it's over, cadovers, because then we are maybe not on the bus to Argentina. We might be on a racing car to Argentina. I think, in summary, for an investment perspective, it's a good time when you've got a strong rand to take at least some of your money out of the country. You don't want to do this when it's 19 to the dollar. It will go back to 19, and one day 19 will look strong. But right now, I think it's a good idea to take at least some of your money offshore. It's a good idea, at least in South Africa, the money that you have here, to put more of that into bonds. Even though the government is overcommitting itself, it should last 4 or 5 years, a relatively safe bet. And you can always move it from there, the money that you're on. I think I'm a bit careful on stock markets, but if I were to choose stock markets, I'd probably choose the emerging markets and probably value stocks a bit more, but that I'll leave to the stock pickers and the people that know a bit more. The one other thing that I've been thinking of for the last year, but when you've got a lot of uncertainty, when we come out of this COVID, we don't know where everything goes 100%, and there's no alternative in interest rates and short-term interest rates, money markets and that, then I think it makes sense to have at least some of your money in precious metals. It always used to be gold just, but I think, if it's precious metals overall or precious metal stocks, it's not a bad idea. And the one other threat that there is the new company tax laws from the United States. I'm finished with my part. I'll hand over to Tony and I stop my sharing. Thank you.
Thank you, Mike. We're going to now say hi to Tony Bell, who's been running one of our largest funds, if not the biggest fund, the IP Opportunity Fund. Tony?
Right. My apologies. I'll get the sequencing right. Right. Afternoon, everyone. Thank you much for your time. My compliments to Mike, and an excellent presentation. I really enjoyed it. What I'd like to do today is spend a very brief period of time for those of you that have kindly supported the journey of the Global IP Opportunity Fund, just give you a bit of a performance update. And then building on Mike's presentation, I'm going to try and share with you from a fund manager's perspective how I map the next few years and really just amplify some of the key themes that have come through. I think there's so much debate around countries and whether you should be in South Africa or not. As someone who's had the privilege to run global equity, the thing that I find quite stark is that when I go into the global marketplace, I monitor on a daily basis over 700 companies. And for every pharmaceutical company that you have in South Africa, or every bank, or every insurance company, or every retailer, there are between 30 and 50 companies that are much better in the world. And I think that for me defines the next 10-year view. So I'm just simply going to unpack for you what I think those growth opportunities look like. And then I'm going to try and put together or stitch together or thread together the link between the economic perspective Mike has just shared and how I see things from a financial market perspective. And then in some detail, I'm going to share with you the portfolio positioning and how we have brought all of it together to try and find the right balance in the portfolio between the various points that Mike has already raised and additional points that I will raise. The fund has had a very nice journey, as I'll show you in 2 slides' time. It's now 7 years old. It is paired with the My Plan Global Macro Fund. We've had the privilege of winning a number of Raging Bulls, and I think it's been a very credible journey for both clients and the investor in the fund. One of the questions that I've been asked quite often, and quite justifiably so, is what has led to your underperformance in the last short while? What you can see on the slide in front of you is the fund in dollars has returned about 36% for the past year, which is not bad at all. But the benchmark did 48, and in Rand terms, the fund did 12 versus 22. For those of you that are unfamiliar with the fund itself, it really is a fund that looks to invest in a concentrated position of long-term, good global growth stories. And what happened last year was we had this tectonic shift away from growth into value as the world started to, or as investors started to play the reflation trade. And you can see that this trend really started back in September, October, leading up to Biden's election, leading up to more stimulus, leading up to investors' perception that the world would reflate, or in other words, grow more quickly in 2021, as Mike has set out. And stocks like JP Morgan, Anglo's, energy stocks, Chevron, did exceptionally well. So stocks in that camp had done around 60% for the past, since September last year, 2 quarters, whereas the traditional growth stocks that had lifted the equity markets for the past 3 to 5 years moderated quite markedly, and that would include Amazon, Apple, Microsoft, and the like. And it's this shift that caused the underperformance. Very pleasingly, since the US Treasury yield, or US 10-year Treasury, has come back a little bit outside of the market's concern of heightened inflation, which I'll address today, the fund has bounced back quite nicely. You can see over the past month that it's up around 6% in dollar terms, tracking its benchmark, and in Rand terms, following the benchmark quite closely. Net, I'm still comfortable with the long-term performance. This compares the fund to all the participants in the category. You can see over the past month, we're at number 4 out of 48. And what we're looking for here is a level of consistency, single digits over all periods relative to the market would be very nice. And that's what I aim to achieve. So how would we map the future? If we go back a year, there was a lot of concern around economic growth. Would it be a V? Would it be a W, a square root? What would happen to interest rates? Clearly, the focus was on jobs, people retaining their sources of income. The world a year later looks very, very different. And so it's, in a way, it would be conventional to move with the broader economic statistics, but I try to take a step back and say, well, what had we really witnessed, and how may that shape the next 3 to 5 years? And I've come up with what I call 7 pathways. And the 7 pathways try to create some sort of filter through which we can see how countries are doing, how companies are doing, and how regions are doing. And I would suggest, with reference to Mike's comments on South African growth, is that you need to ask yourself, how many of these boxes does South Africa tick, and how many boxes do the companies in South Africa tick in relation to their global competitors. And I think you'll find that very few of the boxes are ticked as far as South Africa is concerned, and very few of the boxes are ticked as far as South African Inc. companies are concerned. And what management normally deals with as part of its strategic planning is they focus on one of many key aspects of the business. So in a traditional business, you look at things like what industry you're in, what sort of competitive advantage, how you build your brand, what sort of distribution architecture you've got, whether your product and your price and your people are correctly suited for the market, how you can compete, and then the extent to which you grow your business, either through taking on some debt or growing organically. Every single company that I look at in the global space has had to deal with all of those 7 simultaneously. More change is here to stay. More debt, Mike has covered. More local, regional focus, more inequality. It's not something that we're going to wish away. It's a structural part of this evolution. Very obviously more digital, more innovation, and more sustainability. And so these 7 factors really take you into a completely different dimension from the traditional growth and inflation metrics. And it provides something of a test, a yardstick, a sort of a checklist against which I go about reviewing companies. And unless companies are able to tick at least 5 of the 7 boxes, obviously you don't want companies with more debt. I'm looking for companies that can innovate, sustain, that are more digital, that are adaptive to more change, that can address these things like inequality, ESG, and so forth. Then I think companies and countries will start to lose competitive advantage. So just on a quick flip through basis, some charts that might put this in perspective for you. Today, I think there are 420 people on the call. We're all Zooming. Apart from a few glitches, we're all comfortable with it. Zoom today is worth more than all the airlines in the world put together. That's quite an astounding concept. I have to include Tesla in a presentation. No, I don't hold Tesla in the portfolio. I was very pleased with the acquisition of Volkswagen before the price moved. But you've got to ask yourself a question. Is Tesla a motor car company or is it an energy company? For those of you that might be interested, Jeremy Rifkin, a Columbia School business professor, has done some really interesting work on how the marginal cost of everything is reducing to zero. In simple terms, what that means is that companies and countries that have innovated in new models of energy, wind, alternate, new models of production, new models of management, new models of distribution are starting to bring their cost of goods and services down at quite a rapid rate. So imagine a country like Germany that has for many years invested in clean energy. Once the equipment that produces the energy has been amortized, written off, or depreciated, the marginal cost, in other words, the cost per unit of electricity, becomes close to zero. That translates into a highly efficient transportation system where your electric vehicles now transport goods and services around at near zero. How does South Africa compete with that? This is a picture in an e-commerce world. You can see the post-COVID forecast exponential growth of 34%, but global trade slowing down to a lower trajectory than what had been expected from 1990, when China was in the ascendancy and globalization had come to the fore. One of the features of all the money that has been paid out, as Mike has pointed out, is that folk around the world that have received stimulus checks have not spent it. They have used it to pay down debt and save it. And that forms a very integral part of how I see financial markets at the moment. and I'll touch on that in a short while. Mike's covered that very nicely, but you can see that the explosive nature of forward debt is something that we haven't seen. The last time debt was accumulated or money was put into the economy at this level was post the Second World War. So talking about the money itself, this is really a scene setter. The line shows you how much the monetary base has increased. MP1 stands for Monetary Policy Version 1, MP2 for Monetary Policy Version 3, 2 and MP3 for Monetary Policy Version 3. The point of that is not really to get into an economic dissertation about monetary policy, but just to point out to everyone who's on the call that gears have shifted. The days of a central bank fighting inflation by raising interest rates are a thing of the past. At the moment, the central bank policies around the world look to put as much money as is necessary in to stimulate growth, devalue their currency, import inflation, and make their countries more competitive. So central banks, if you like, are competing with one another to ensure that their place in the sun is secured. South Africa does not have that luxury. We cannot expand our monetary base or we'll blow our currency out the water. The consequence of that is policy guidance by all the major central banks, as Mike has pointed out, is lower for longer. And these are indeed unusual forecasts. Mostly what central banks would be doing at this point in time is starting to prepare investors for interest rate hikes as inflation starts to move through the system. And that would have been the traditional post-1984 Volcker era, which was succeeded, of course, by Greenspan and then Bernanke and Jerome Powell of late. I'm not going to go through this at all. The purpose of this slide is really to give you a lot more detail, which you can review at your leisure. It sets out the 7 pathways, what the key drivers are, and my best judgment call of what the investment implications are. And you can see with each, there's a highlight around health tech and fintech and green tech. And that's just a scene setter to the discussion that's going to come about on sectoral change. So the thing that got the market all ruffled over the last quarter was this 5-by-5-year forward break-even inflation rate in the top panel. And the market was concerned that US inflation would print a lot higher. Indeed, it did. And this would be a trend change. For reasons that I will explain today, I'm not that concerned about inflation in the short term or the medium term in the US. It will print higher in the next few months. But bearing in mind that the Fed looks at a number of component parts of inflation, of which core inflation is very key, and that has been very stable at around 1.5%. Yes, we are picking up price increases because of supply constraints and the base effect of March last year. But as I'll show you in a moment, there's another variable which we need to think about. Why is all of this or any of this important? Well, as you'll see in the next few slides, the way in which the equity markets price forward earnings has a lot to do with forward inflation expectations and forward interest rates. And the Fed itself sees only a modest rise in forward inflation, and it has guided that no rate hikes are likely before 2024, and that's quite significant. So against the backdrop of a low interest rate, low inflation environment, it stands to reason that growth stocks over time should do a lot better because of the compounding effect of their earnings. Something that Mike can shed more light on, but a very quick tour de economics around monetary policy and velocity of money. Effectively, what this says is the amount of money that's been pumped in, which is substantial, and how quickly that money circulates in the economy is equivalent to the price of the goods and services times the quantity of goods and services. And everyone's really concerned that because there's so much more money, the price of goods and services will go up. But what has happened as the money has come in is that the extent to which a single dollar circulates in the economy has declined quite precipitously. So you can see the red line dropping off. And so for every single dollar that's been printed, those dollars have circulated less and less. And that means that the net effect at this stage of all the money printing is not inflationary. Why is that important? Because it has a bearing on the US bond market. So as velocity of money drops, the impact on the bond market itself on the read-through to inflation is lower velocity equals lower pressure on inflation, and hence I don't see a blowout in the bond market. This was the little spike in the bond market that caused a lot of consternation. I see the bonds very comfortably potentially drifting back to around 1.5 on the US Treasury. And the simple read through for me in the short term is I don't see the risk of an equity market blowout because the bond market blows out in response to inflation. So we're having a little bit of a melt up. It's a nice place to be when the performances come through strongly. You know, ergo 34% in dollar returns for the last year is quite an exceptional return, even if it was a little bit behind benchmark. But I think the melt up itself brings with it some caution, which we need to be aware of in how we manage the risk component of your portfolio. So when you have a look at the rating of the market, the price that the market pays for future earnings, we're currently around here. What we see on the horizontal axis is that US 10-year Treasury yield. So where I would be concerned is if the Treasury yield went up too quickly, the price earnings multiple of the market would drop. You can see that there are very few dots over there. We don't have situations in the past where yields rise and PEs rise at the same time. PEs tend to come off quite sharply. So to give you a feel for what the market is expecting, earnings of the S&P 500 will increase quite substantially this year and into next year. So the good news is earnings are growing nicely. But I would think that given the relationship between inflation, US Treasury yields, and the PE ratio, that we've got to be a little bit more conservative in where we see the market a year or two from now. And it shows that in aggregate, the market is reasonably priced for the earnings that are coming through, but there's not a lot of upside outside of earnings surprising to the upside, and I'll address the Biden effect in a moment. So one of the comments that Mike has made is that Biden is introducing quite significant tax increases, and those will have something of a dampening effect on earnings. And so whilst I don't see pressure from the interest rate environment, I certainly see analysts forecasting earnings to be a lot lower than what they forecast at the moment. One of the comfort factors, if you like, is that all of these market bubbles that have popped have normally popped because the interest rate set by central banks have either been on the increase or started to increase. Normally the bubble pops sometime into the interest rate cycle, and Powell has indicated, Powell being the chairman of the Fed, has indicated he doesn't really see rate hikes even in consideration until the end of next year. So we're in something of a Goldilocks scenario, but the market is tending to be a little bit complacent. Volatility is a fancy term for how much risk the market sees over the next short while. In other words, how bumpy is the equity market going to be? And at this point in time, the Chicago Board of Exchange, which is the CBOE component, sees very little bumpiness ahead. That normally has a fund manager on slightly higher alert. together with the amplification of this chart, which builds on what Mike has already shown in the call put ratio. This is just the number of call options traded on the S&P 500 index on a 20-day moving average. Now, a call option is somebody who comes along and says, I don't want to buy any shares, but I've got some cash. I think the market's going to go up. So I want to buy an option that if the market goes up, I'm going to make some money. 30 million contracts a day, the market's running a little bit hot. There's a lot of retail investors speculating, and I'll deal with cyber currency at the end of the presentation, but this is not normally a sign that one wants to be a bit more cautious and moderate in the positioning of the portfolio. If we have a look at sector positioning, the sector positioning at the moment is reflective of the option graph that I've just showed. The market is favoring the sectors that Mike referred to: food staples, banks, diversified financials, the industrial complex, the semiconductors, certain tech, and you can see that the breadth of the market is quite wide. So from an investor's perspective, it's very encouraging to see that what was essentially a tech rally up until around September last year has broadened out to include the energy complex, the materials complex, financial sectors, and also industrial goods sectors. And that's a good sign for the short term. So the way I have, in closing, split the portfolio up to share with you is I've analyzed the portfolio in terms of core growth, recovery, and next generation. And what you can see filtering through the portfolio is that there's certain stocks where I believe the compound effect of earnings growth will persist for some time. And these are typically companies with very dominant positions in industries where they're able to dominate and also maintain their margin. Companies like Alphabet, Amazon, MasterCard, Apple, Microsoft, broad base on the Russell 2000, etc., etc. In this camp over here, you'll typically find stocks that are more geared to the recovery, like your bank stocks. In there, we've paired JP Morgan, Royal Bank of Canada, and Bank of New York Mellon, sits down over here. We've got a number of stocks on the entertainment and sort of broad-based economic recovery. Starbucks, people going back to coffee shops. Caterpillar gives you very nice exposure to a range of base industries. Costco on the cheap end of the retail sector, Booking in the travel industry sector. And then you'll see next generation being a number of new themes coming through into the portfolio. I've held many of these stocks for quite a while, but they sort of fit quite nicely into the new world theme. Vestas Wind System, new energy, VW, new vehicles, PayPal, new payments, Thermo Fisher, new medical. Square is another company in Europe that offers online payments facilities like PayPal. We've invested in a clean energy fund that pairs nicely with a US company called Waste Management. We're all familiar with Spotify, and then a specialist chip manufacturer. I am managing the portfolio with an eye on the downside risk. I hold a reasonable amount of cash at the moment, and I have started to build a short position in S&P futures so that one has a little bit of a hedge when that volatility increases. And just in closing, Magnus, to answer one of the questions that already been put, what about cryptocurrency? And I've got two slides to share with you, this slide and the next. When you look at cryptocurrency, there's an important consideration to take into account. When you go along to a bank and you ask for a mortgage to buy a house, the bank actually creates new money to meet that liability. A cryptocurrency doesn't have the ability to create money. And so what you have is you have a defined asset pool. In other words, there are a limited amount of Bitcoins being minted, and you have a lot of liquidity looking for alternates to the dollar. So it's no surprise that on the left-hand panel here, the Bitcoin rate, 52-week rate of change, read off the left-hand scale, is inversely proportional to the dollar. So as the dollar weakens, the attractiveness of alternates like Bitcoin, which many would argue are a proxy for gold, is more appealing. At a more technical level, it's also about a risk on trade. But the key that I want to share with you, and it's also a little word of caution, I've been through many a bubble in my investment career, and they all tend to look fairly similar. What concerns me about the Bitcoin market is you can see that the total number of wallets that exist, the top 100 wallets own 13% of all Bitcoins. And as you can see, the number of wallets having increased, the number of Bitcoins per wallet has now dropped to 0.3 Bitcoins per wallet. So when you look at the concentration of Bitcoin ownership, the top 100 wallets own 13% of all Bitcoins manufactured, and all this liquidity that's flowing into Bitcoin and the price, crypto funds inflows, is increasingly supporting smaller and smaller holdings of Bitcoin. So Bitcoin is really set in price by that top 13% of holders. PayPal is one of them, Tesla is another. So it's very hard to determine what the value of this thing is or where it's going to go to. It really is all about flows. And I think the underlying theme to the presentation today is be very careful when you look at the flows, because the flows themselves ultimately define the direction of the price of the asset. On that note, Magnus, I will say thank you, hand back to you, and participate in any questions that get asked.
Danny, thank you very much for that. And I'm very glad that you took the opportunity of answering the Bitcoin questions, because I was not going to do that. But that was a good summary of the fund. You've been doing very well for us. It's been an absolute star performer for the Brenthurst funds, and also for the clients invested in that particular fund. And thank you for that. We have one or two questions, maybe, and I think Mike has answered the question about the Rand very clearly. That's in line with our advice to our clients for the last period of time, that the timing of purchasing dollars is very important. And I think one of my slides, which I was going to show, shows very clearly that the Rand is getting close to a period to buy dollars again. And normally that is, from a longer term perspective, a very good time to buy US dollars. And but Mike, the one question we got asked is about long-term rates in South Africa. Can they go even higher? And maybe just a very quick answer to that question, please.
Yes, I think, we are likely to see interest rates for the long bond increase. Two reasons. One, inflation in South Africa is slowly increasing. We can just think of electricity and water. But I don't think right now it's going to blow out. But where it will blow out is when we get further downgrades. Then the interest rates obviously on the long bonds will increase a lot. But I still think it's a worthwhile investment because, you're getting close to 10% on a 10-year bond. I'm not quite sure what the 5-year bond is. I'm not in the market, but I think it's about 7 or 8%. In an inflation environment where one expects inflation to go around average, say 4% this year, a bit more than 4% next year, that's at least a reasonable return. But again, you don't keep everything in one basket. But I think I would rather have a bit of money in the next 3 or 4 years in the bond market than I want to have in the bank, because the bank's going to pay me even less. And yes, you have an inverse price relationship. I do understand that. But remember, you're buying in not at a very uppish level here where the price is very high and the yields are low. I think we're looking at Yeah, it's not a balanced necessarily, but it's seen a lot of weakness already. So you're not buying in on a top of it either.
Well, thank you very much for that. I think we're gonna end it there. People can approach their advisors countrywide for more specific questions. I do apologize for my slides, which I spent a considerable amount of time drawing up, but they will be put onto our website. My technical team has just told me. I'd just like to summarize the positioning of Brenthurst as far as advice is concerned. First of all, we are totally independent of asset class and a fund management company. We try and find the best returns for our clients at the lowest possible rate of return. So that's point number one. At the lowest rate of risk, of course. Secondly, we are not dictated to by fund managers that force us to use their funds. We are independent and we choose our own funds, which is very important. I think one of the things happening in the South African investment world is that most or a great percentage of the advisors are tied to the large investment companies, and they have to recommend those funds irrespective of the returns. And some of the returns I've been seeing over the last couple of years, especially in pension funds and retirement annuity funds, have been horrendously low, and they are driven down by costs and bad choices, etc. We feel that most South Africans are still overexposed to South Africa when you look at their overall asset base. So I'm talking about local properties, businesses, pension funds, RAs, and that has made them poorer over the last 10 years. And it's not only myself and people like Mike saying it. I think mainstream media is picking up on this, and foreign commentators are saying South Africans are getting very, very poor. And it's up to them to step up to the plate and say, how do I arrest this decline and turn my fortunes around? I've written a piece which will appear later this week on Network 24, where I try and answer these questions about the next 10 years in South Africa. And unfortunately, it is not a very good conclusion I come to. So thank you to all our clients listening, and also our newer additions who wanted to listen to what we do at Brenthurst. Thank you to our speakers and to our technical team, my wife Sue Heystek, and of course Darlene van Wyk, who've been organizing this webinar for the benefit of all our clients. And I see more than 400 people stayed on until the last couple of minutes. So I'd like to thank you. If you'd like to talk to any of our advisors countrywide, we have 8 offices, including our new office at Val de Vie, which has just been opened, and of course our office in Mauritius. With that, I'd say goodbye and thank you very much. Good night.